we stopped here, right? Basically, we stopped at working capital, but I will start from this point today. Okay. So these are the ratios we are going to look at, and these are the ratios which are more important, right? We have the liquidity ratio, which indicates the short-term debt-paying ability of a company. That means when it can be bank financing or it can be creditors, any short-term, any liability which we need to settle within 12 months period of time, right? Within 12 months, within a year, right? So liquidity ratio gives an indication of the ability of a customer to repay the short-term borrowings and liabilities, right? So that is liquidity ratios. Then we have the equity ratios or long-term solvency ratios. This shows the relationship between equity and the debt. What does that mean? If you can imagine the P&L and the balance sheet, we have fixed assets, then we have current assets, then we have current liabilities, then we have the section called finance by, which is shareholders funds or the owners fund, and owners funds or partners funds or shareholders funds, right? All these three, depending on whether it is a sole proprietorship, partnership, or a limited liability company. These words are used. So this part is called equity capital, whereas long-term borrowing, that is any borrowing which needs to be repaid over more than 12 months period, are categorized here. It can be term loans, it can be leases. That is called debt capital, right? So the relationship between equity capital and the debt capital is calculated under this equity ratios, right? Again, whenever the debt capital increases, that means in a business, if major portion of funding has come from debt, then it is little riskier. Why? Because out of the income a business generate, major portion need to be allocated to service the debt in that case, right? So businesses does not go on an increasing manner on day by day. So it is a fluctuation. 1 month, January, you will have a very good sale. December, you will have a very good sale. But when it comes to February, sales will drop. So if your re, repayment amount requires a major portion of your profits, then you will not be able to pay because there are fluctuations, right? So we say there is a financial risk in this company when your debt portion increases. So we look at this long-term solvency ratios in order to identify the relationship between debt and equity. We say a company which has a 20 million total assets, 5 million is from equity and 15 million from debt. In that kind of a scenario, major portion, 75% of your income needs to be allocated to service the debt. Right? So that is a riskier part. Then we have the profitability. Like as we discussed, we have financial performance, which indicates the performance of a business, and financial position, which indicates the snapshot of the business, which is the balance sheet. Performance is the P&L. So why we do business? To earn profits. So profitability test it relates to P&L ratios, right? All the P&L ratios we talk about profitability test. Then market test. This is purely we work for listed companies, right? This allows us to compare two listed companies, right? Whether prices are good, whether it is, just give me 1 minute. So market test is to look at the uh, comparison between two uh, listed companies, right? Whether prices are good, whether future prices, what would look like future prices, what is the different comparison between market price and the price earning. So we will look at those things. Further, going to these ratios, we can create any type of ratio, right? It depends, you can word. Then there are other ratios like efficiency ratio within this liquidity. But as I discussed earlier, as I discussed earlier, uh, what happened through ratios, we can look at the management efficiency, how management thinks also. So we can create efficiency ratios. So it shows you how the management thinking, like how their debt collection, how is their planning on stocks, how is their planning on repayment of short-term like creditors. Those kind of ratios can be created, and that is purely efficiency. So it is to do with management and the efficiency of the business, right? Then on the ratios, whenever we are doing a ratio, if I am using the uh, both figures, from all the figures from balance sheet or P&L, you can take the figures as it is, right? But if any denominator or numerator, anything comes from P&L and balance sheet, both. That means I'm taking figures to calculate a ratio from both P&L and balance sheet. Then balance sheet figures can be taken as, P&L figures can be taken as it is, right? If P&L says, like we are working a ratio, uh, and we need to take figures from P&L. Turnover is 100 million. We take 100 million as it is. Then we want debtors. In that scenario, we are taking the debtors of this period, the period where we are calculating figures, and the figures of the previous year. And we divide by 2. These two figures, that is to get an average figure, right? Always balance sheet figures should be on average. P&L figures can be taken as it is. Whenever you are calculating a ratio using figures from both P&L and balance sheet, right? Don't mix it up. If you are calculating a ratio using P&L alone or balance sheet alone, you can take the figures as it is. However, if you are calculating a ratio using P&L figures and balance sheet figures from both the statements, you need to get the average figures from balance sheet, and P&L figures you can take as it is. Why it is so? Because P&L is for a period. It can be for a quarter, it can be for half a year, or it can be for a year, right? So it is for a period. But balance sheet, it is for a specific day, right? Then there is a time difference. In order to avoid this time difference, you take the average from balance sheet, and P&L, which is for a period, we take as it is. So don't forget about that. That is very, very important. Right? These are the ratios we will be working. Current ratio, asset test, uh, account receivable turnover. I will go into details. I think we just discussed the first two last week, but I will go through it. Right. Okay, these are the figures we have. We can use. Right. Working capital. We are just after this presentation, we will be going to working capital. For the time being, we will look at what is working capital. That is current assets minus current liabilities. Right? Working capital is the funding we need to run the day-to-day operations of the business. You can have assets, fixed assets, you can have machinery, you can have everything. But if you don't have money to run the business, you can't run the business. Right? Look at ourselves. We may be having a vehicle, we may be having a house where we can live, right? But if you don't have rupees to run your day-to-day life, your food, your clothing, all those things, you don't value the other things. So working capital is the most important part of a business. You can have all fixed assets, but if you don't have stocks, when you don't have debtors, when you don't have cash, when you don't have creditors, and when you don't have short-term borrowing, then you can't run a business, right? Basically, uh, debtors and creditors and cash plays a major role because that helps the operation. Financing it happens from creditors and short-term. So working capital is the funding required to run a business on a day-to-day basis. Right? So current assets minus current liabilities is working capital. Normally we term as working capital. That shows the liquidity. Why? Current assets is the minimum assets amount of current. Any asset which can be converted to cash within 12 months period is current assets. So uh, working capital, like current liabilities, fund part of the working capital, right? Current assets minus current liabilities means the part of the current assets which has been financed by long-term funding. That means you don't have a hurry to repay that part. So you have a liquidity. You have enough time to repay that. But when you're talking about current assets and current liabilities need to be settled within 12 months period. Any liability which needs to be settled within 12 months period. So if all your current assets are financed by current liabilities, that means within a year you have to sell everything and settle everything. But when you have part of it financed by long-term funding, that part you don't need to settle in a hurry. So you don't have to push the current assets and sell it, convert the stocks into sales because you have time to settle. So that indicates the liquidity in the business. So though we talk about working capital here, it is not a ratio, but it indicates the liquidity of a business, right? Then we come to current ratio. Okay, current ratio is current assets divided by current liabilities. What are they in current assets? We have stocks, we have debtors, we have advance payments, we have amounts given to owners or uh, amount paid to directors. Then we have cash, right? So stocks we convert to finished goods, then we convert to sale, then it will become debtors, right? So always we want to convert stocks into raw material into finished goods and finished goods into sales. Sales, if you take it through cash sales, your cash position increases. If it is credit sales, your debtor position increases. So after few days, you collect debtors, then again cash position increases. So how the business cycle operates is you have cash, you buy raw material, you convert to finished goods, you sell the finished goods, and you create debtors, then these debtors will be collected after the debtor period, again cash. So your cash in the business rotate on this line, right? So this cash need to utilize to pay the current liabilities. What are current liabilities? Current liabilities are creditors who has given you goods without accepting cash, without paying cash, right? So you can use creditors to buy goods, but you don't need to pay them early. So once you take the raw material through creditors, you produce the goods, sell, collect, and pay. So there is a timing gap difference between bringing raw material to the factory and paying for the raw material. So that period is creditor period, right? So there are other things like light bills, water bills, then salaries. They pay with a little delay, right? Taxes. So those are called accrued expenses. We count for the month, but we pay after a month, right? So those are accrued expenses. Then we have something called like uh, we have received money from the owners. So those are amounts due to directors or due to partners or due to a sole proprietor. Those are amount due to people which needs to be paid within 12 months period. Then we have short-term facilities, PODs or short-term loans, right? So all these are need to be paid within 12 months period. So by working on this current asset, current ratio, what do we look at? We look at what is the coverage these current liabilities has from the current assets. Why? Our thinking is current liability. I told you this. Current liabilities are settled by liquidating. That means selling current assets. Current liabilities are serviced by liquidating current assets. That means we sell our inventory and collect cash to pay our current liabilities. If there is any interest portion of this current liabilities, we pay through the profitability. But the capital portion of current liabilities, we pay through selling current assets. Why is that? See, we have a creditor limit. We say, I'm buying my raw material, the material, clothes. I'm a shirt manufacturer and I'm buying my material from Mr. Pereira. He has told me, okay, you buy up to 1 million rupees, I'm giving you 30 days credit, right? So whenever I have money, I will pay Mr. Pereira. I have 250,000 now. So I go and pay Mr. Pereira. As soon as I pay Mr. Pereira, he gives me goods. Oh, I have a POD facility of 10 million from BOC, right? So whenever I have a million rupee, I go and pay the POD. Then my limit goes down. So I can retake that money and use to buy raw material. So creditors, short-term limits are basically like buckets where you can fill it, take it out, and refill it. Right? So by settling a short-term facility, your business won't get stuck. You can reuse short-term facilities. That's why we say current liabilities are paid by liquidating current assets, right? But if we are talking about a long-term facility, once settled, you can't reuse, right? That's why it is gradually being paid, right? Therefore, all the current liability holders are interested of seeing how much am I covered from the current assets. Why? If current assets can't be converted to cash, we can't pay the short term. Because firstly, we have to pay the short term. Short term means any liability which needs to be serviced within 12 months period. Right? If I can't convert or if I can't sell the current assets, I won't be able to settle short term. So short term lenders, short term suppliers, they are worried about the ability to convert current assets into current cash. So the coverage, the short term lenders and short term current liability holders has is calculated using current ratio. So current assets divided by current liability is current ratio, right? Measure the ability of the company to pay current debt as they become due. So from the example, current assets which is 65,000 and current liability is 65,000, current assets 42,000. So you divide this, it is 1.55. That means each rupee of current assets is, we have current liabilities of 1.55 rupees, right? For each rupee of current liabilities, we have current assets of 1.55. When you divide by this, you get 1.55. So we denote the current ratio as 1 is to 1.55. If we omit the colon and the 1, if we say 1.55 times, that means each rupee of current liability is covered by 1.55, right? That is current ratio. Then we have acid test or quick ratio. What does that mean? See, on the current assets, we have stocks or inventory, right? Which is written close to fixed assets. That means inventory is the hardest to convert into cash, right? Inventory is the hardest to convert into cash. So if we create a ratio called quick ratio or acid test by taking out inventory from the current assets minus inventory divided by current liabilities, right? That is the acid test or quick ratio. That means what is the coverage this current liability people have from the current assets, which we exclude the inventory, most hardest to convert it to cash, right? What is the coverage we have? Because inventory need to be converted to finished good need to be converted to debtors need to be collected. Or if the business stops, we need to sell the inventory to get cash. Selling someone inventory by a third party is a very difficult question, right? So that is quick ratio, right? If you don't have any uh, details about the current assets, we can take current assets minus inventory divided by current liabilities at quick ratio. But if you have details about the current assets, then you take cash, marketable securities, account receivable means debtors, and notes receivable. Those are also short-term money given out. We need to collect, right? So all these things divided by current liabilities is quick ratio. Then we can calculate another ratio called cash ratio. That is cash divided by current liabilities. Cash ratio is cash divided by current liability. Cash ratio or cash coverage, right? So normally, if we have a current ratio which is more than 1.5 to 2, that is a reasonable current ratio. If I have a quick ratio in the range of 1, it is a reasonable quick ratio. If I have a cash ratio 0.5 to 1, it is a reasonable ratio, right? Because inventory has been taken out. But if you have a current ratio which is 5 times or which is 4 times, what does that indicate? That indicates inefficiency of the management. Why? Current ratio is current assets divided by current liability. So higher the current ratio means smaller the current liabilities of a business. Right? See, we have 20 million current assets and 10 million current liabilities. Right? 20 divided by 10. Right? That means 2. Right? But if my current liabilities are 5, that means major portion of current assets are financed by long-term borrowing. That means you have not utilized your creditors or you have not utilized your short-term funding. Rather, you have used your equity or long-term borrowing to finance your day-to-day operations. What is the difference? Creditors means free cash for you if there is no added margin for credit, right? Larger margins. So you take your raw material or finished goods, but you don't pay the supply. You go and sell. Once you collect, only you are going to pay. Okay? So it is free goods for you. If you are not utilizing that and you are utilizing your owner's funds, owners expect profits. You utilize your long-term funding. Long-term funds are at a high cost normally, right? Like you have not used your POD, so short-term facility. When you compare a short-term facility and a long-term facility, short-term facilities are low cost. Long-term facilities are high cost. Why? Due to risk. I have shown you with time risk increases. So therefore long-term borrowing comes at a premium. Short-term borrowing comes at a low premium. Therefore, if the current ratio is high, that indicates a inefficiency or conservative management thinking. Why? When your current ratio is small, your coverage is small. That means you have used lot of short term. So you need to be in a very good position to sell your inventory, collect your debtors and pay the creditors. Because creditors are maturing very fast. Whereas long term funding, you have to just pay a monthly commitment and you can pay it over 5 years, 3 years, 4 years, whatever. Right? So you are very conservative. You don't want to take any risk. But in a business, you need to take a calculated risk. Right? So higher current ratio does not show a good picture. It will be very comfortable for the current liability holders. But for a bank, that indicates a negative outlook. Why? The management of this company is not very active. Right? They are not very active. They are not very efficient that way. So they should have used the current liabilities in order to finance. Right? Okay. Do you have any questions on this before I go to the other part? Since I don't have the board, I can't write anything. I'm just explaining. Right? Are you in line with me? Can I go ahead? Can someone tell me whether you understood or not? Okay, thank you. The quick ratio, if you work out from the previous one, you have 30,000 and 20,000. You see? Cash, you have 30,000 here. Account receivable, end of the period, it is 20,000. Inventory, 12,000. That's how this 65,000 came in. 30, 20 plus 12. There has to be something else. So that's how it is 65,000 added up. So there's a 3,000 notes payable and short term. Right? Then current liabilities are okay. This is the thing. See this prepaid expenses 3,000. That's how 65 comes in. Otherwise, it is 62. Right? So 30 plus 20 divided by 42, it is 1.199. So quick ratio is always less than current ratio. Why? We have taken out the inventory. Then we go to account receivable or stock things. Right? These are liquidity, but we term these things as efficiency ratios, right? We term these items as efficiency ratios. So similar to this, we will start with stock turnover, right? So it is stock turnover is equal to cost of goods sold divided by average inventory, right? You take the cost of goods sold from the P&L, which is the direct cost part, divided by average inventory. Why? Cost of goods comes from P&L and average inventory comes from balance sheet. So we take average inventory here and cost of goods sold from the P&L as it is, right? Someone can argue stock turnover period we need to take only the raw material. Yes, you are correct. You need to take only the raw material, but most of the times we can't find raw material alone. So what we do, we take cost of goods sold, right? It will give you a little difference, maybe a day or two difference, but we use this as a general rule. Okay, cost of goods sold. What does this ratio indicate to you? Raw material convert to finished good convert to sales. This ratio, stock turnover, indicates how many times per annum stock converted to sales. Our aim should be any business, our aim should be to create sales as fast as possible, because we don't want to hold money in inventory stocks, right? No point just holding money in inventory. Our aim is to sell something, get money, and profit. Always, whenever you sell something, you generate a profit, right? Just holding inventory, you don't generate it, just you are dumping your money, right? However, there are instances where you need to hold stocks. Like we say, you are in the construction industry. You are in the construction industry, right? Then you need steel. But there is a scarcity of steel in the market. In that kind of scenario, you need to have a larger stock with you in order to convert or continue your construction work. In a scenario where there is no scarcity in the market, you can go to the market and buy whatever you want. There are no price fluctuations, scarcity and price fluctuations, right? Always. Whenever you take the decision on stocks, you need to consider scarcity and price fluctuation. If there is no price fluctuation in the market, you don't need to stock, because it is with the sellers. You can always buy. So you need the minimum stock with you, right? So your aim should be to convert stocks into sales always. So this ratio indicates how many times per annum you convert your inventory into sales. And this ratio is very, very, very critical. Three ratios I am talking about now is very important for a credit officer or a person who is looking at credit. Why? Whenever we are talking about working capital, from the customers we meet on a day-to-day basis, 80 to 90% comes from working capital. So all of you need to know what is working capital, how to calculate it. Then only you can immediately work on the requirement of a customer. So stock turnover and stock turnover period is very, very critical. Right? Please pay the full attention to this. Right? Stock turnover is how many times you convert your inventory into sales, right? Stock turnover or inventory turnover. Then we have another ratio. This ratio will work out as times, right? Then we have a similar ratio from the same thing, stock turnover period, right? Which is equal to 1 divided by stock turnover, right? Listeners, into 365. This ratio indicates by days. Result comes in days, right? The same thing can be written as average inventory divided by cost of goods sold into 365, right? So it gives you number of days. What does this mean? This means how many days on average the business take to convert raw material or your inventory into sales. How many days on average you take to convert your inventory into sales. Earlier what happened? We took how many times per annum you convert your inventory into sales. This shows how many days on average you take to convert your inventory into sales, right? So these two ratios are important. Whenever we are working on the working capital, you need this one, right? This is very critical number of ticks to find out the working capital cycle. If we do working capital cycle today, we will look at, we need this ratio, right? Average inventories remaining or total. Sashini, why you can't see the Word document? Sashi, you have a question. Can you please change the display setting again? Can't you see tell someone please tell me, can't you see the Word document properly? Okay, how we take the average inventory is the question, right? It is beginning of the year and end of the year, right? Stocks. So if you don't have the beginning and the end, it is like you have 2 years financials. You have, we say, I show you. See this beginning of the year and end of the year, right? How can we find this? Right? See this one, inventory, beginning of the year, right? You're clear? Inventory, beginning of the year and this. Right. When I'm on the full presentation mode or Word document, I can't see the text box, the chat box. So please speak out at that time. You can use any language, right? Though this is not Tamil, I can't understand Tamil, right? Sorry about it. So මට කතා කරලා කිය අහන්න නිකන් ඉන්න එපා. Don't worry about the language. Though this is the English medium, you need to write the things on English medium, but the essence should go into your head. That's the aim. Okay. And this is not English class. Don't worry about English. Right. So, okay. So this is the average inventory. So always average means අපිට අවුරුදු දෙකක් තියෙනවනේ ඒ දෙක අරගෙන බෙදලා ගන්න. එහෙම නැත්නම් beginning end තියෙනවනේ beginning and end plus divided by 2. Right? So this is the first efficiency ratio, which shows how efficient is our stock conversion to sales. Right? So why do you need this? Why do you need this? Very not recently, once I met a spare parts business customer. Right? So he had a stock turnover period of over 250 days or something like that. It was huge. Why? Why do you need that much stocks? You don't need to. Because you can buy stocks or import stocks at any given time. Nowadays we have issue, that's a different case. But we can get the stocks you need. Then why do you need to hold that much stocks? 125 days or 200 days means what? You have stocks enough to sell for 250 days. That means more than 2/3 of the year. Why are you holding your money for that long? Then I asked him why. Then he knows that there are stocks which I can't sell, but still it is in the stocks. I got that stocks, one piece, 400 rupees. Now it is, I can't sell, no use of it. Now they are asking for the weight, 1 kilo, 400 rupees. So I don't feel like selling. So I have kept it in the stock ledger. Right? So is it right? No, it is an obsolete stock. We say it is obsolete. We can't, no use, just scrap value. Right? So when you take out that part, okay, when you take out that part, the stock turnover came down to 120 or something like that. Then it is a reasonable thing. 200 odd days is not reasonable. Based on your industry, you should know, like you should guess what kind of a stock turn. Like there is a baker comes to you, bakery owner comes to you for a facility. And what is your questions? කොච්චර විතර stock එකක් තියෙනවද ඔයාලා? What is your stock? If he says, he says a figure and you calculate the stock turnover period. If it is 5 months or 4 months or even 3 months, you should be worried. Why are you keeping this much stocks? In your business, you don't need. You can buy flour at any time. So if you keep 2 weeks, 3 weeks, or 1 month stock, that's more than enough. You're just holding your money there. Why are you asking our funds? Right? So you need to know whether he's telling lies or he's just dumping money. Right? When money is in the stocks, you can't create sales, and then when the short-term things comes mature due, you don't have money to pay. So stock turnover, based on the industry, you have to see whether it is too much. That means you have obsolete stocks. It can be obsolete stock, or it can be very conservative. I have enough stocks. I just wait and see when. So those kind of things. Okay. Once we had like one of my friends who is in construction. He always have issues to settle his PODs and short-term loans. Right? Then another friend of mine who is a chartered accountant and a CFO of another company. So we went into his business to look. My friend is an engineer by profession, and he operates a construction company, right? So we to look at his business, then to see he has a huge stock of steel, right? Then we asked why. And he was saying, no, I need steel, so I'm putting all my money into steel. Since he has lot of stocks, his cash flows get stuck there. Then he couldn't finance the short-term maturing debt. So we had to force him to sell part of his stocks and maintain the minimum stocks. And then he did it. Now he does not have an issue of paying his short-term recurring liabilities. While he is not dumping money into stocks. So now his stock turnover period has come down. Whenever he needs stocks, he can buy from the market. But for the day-to-day run, minimum stock level he maintains with him now. So whenever you have a customer who has an issue with paying their short-term liabilities, this can be one reason. So you have to look at this. So that is stock turnover period, right? Then we will work a similar ratio, which is debtor turnover, which is equal to credit sales divided by average debtors. This also comes in times, right? What does this ratio tells you? How many times per year on average, right? How many times per year you convert your debtors, that is your credit sales, into cash? How many times per year you collect your debtors? How many times, right? Why is it important? When you sell for credit, you increase your revenue. That's good. You are a shirt manufacturer, you go to the market and say, I am selling shirts, 1 year credit. Everyone will come and buy from. Or if you go to market and say, I am paying only on cash, very few people will come. So by giving credit, you can increase your sales, but your business will be at problem. Why? You don't have cash. Yes, you have sales, but you don't have cash. So collection is the key most important activity of a business. You can sell, but if you can't collect, no point doing this. Right? Then debtor collection or debtor turnover indicates how many times per annum we collect our debtors. Right? The larger the number here, that means 10 times, 12 times, 50 times, like that. Larger the number, better the collection is. Right? We collect only 2 times or we collect only 3 times. That is bad because we take lot of time. Right? So similarly, you can work out period, which is equal to 1 divided by the turnover or data collection into 365. Right? The same thing, it comes in days, right? It is written as average debtors divided by credit sales into 365. Right? This is comes in days. That is, on average, how long you take to collect your debtors. On average, how long you take to collect your debtors. That is, on average, what is the credit period you have given. Right? Longer the credit period, that means you won't get cash. Therefore, credit period should be short as much as possible. Then you get cash faster. When it is fast cash, you don't need much borrowings because you are getting cash regularly. I can remember Damru, right? When we were financing Damru long time ago, right? They were giving, I think, 2 months or 3 months credit at the beginning of their journey. Then suddenly Mr. Ramanayaka said, no, we are not going to give that much credit. I'm going to convert it to cash or 1 month credit or something like that. Right? Then he told us we will be having issues in paying you because our sales will drop. Yes, when they came, then they took the decision, their sales dropped. Why? People who were buying stopped buying. Why? Because they were not getting credit and they didn't want to pay cash. So for few months, this company was having issues to settle the short term because their sales levels and the collection has come down. Then gradually it picked up. So everyone adjusted and started buying at 30-day credit or something like that. Right? So then what happened? They were getting money faster. They were not utilizing limits. So they saved from the short-term interest portion, right? When the debtor turnover is high, that means the number of days you take to collect debtors will come down. So you are getting your cash faster, so you don't need to utilize your ODs and short-term facilities for a longer period. You don't use it means you are paying less to a bank, so your profit goes up. Right? This is debtor turnover, is number of times. Debtor collection period is number of days. Right? All this comes in two forms. Right? So remember the first few discussions we had. When a customer comes in terms of trade, you ask how are you going to sell? How much is credit? How much is cash? So at that point, you note it down that okay, he's selling 30% on cash, 70% on credit. And what is your credit period? Normally 7 to 30 days. Right? That is the initial discussion. You need that information to calculate this. Credit sales. You have a sales percentage 70. If the financial shows you 100 million, that means 70 million is credit. So you need that information to calculate. And again, you have a cross-selling, cross-checking opportunity. There they say, I'm selling to 7 to 30 days on average. Right? Then when you work out this, it shows 120 days or 90 days, much higher than this. Okay? Then your natural question should be, why is this? Then the natural answer would be, there are some debtors which I can't collect, or which is bad debt. So you have to find out the bad debt portion and take it out. Right? So this shows the ability. So based on the industry, again, debtor collection period you have to question. So always you have to ask, is there any bad debt in this? How long? Larger periods. So you can collect the age analysis. That means, okay, within 30 days how much, within 20 days how much, 21 days how much, within 45 days how much, within 6 days. So that is the age analysis. It indicates the aging of your debtors. So he says 30 days. If your aging is more than 30 and it is 90, 120, that means that part you can't collect. You will have to adapt something else. This is not normal. Right? If a bakery and says you have 120 days debtors, which is wrong, something wrong. Right? Pangediya dawas dekai. But you are talking about 120 debtors. There is a issue. So we need to identify that before going into the funding. Right? Data collection is that. Then we come to creditor. Right? That is equal to cost of goods sold divided by average creditors. That also comes as times. How many times per annum you settle your creditors? How many times per annum you settle your creditors? This can be written as creditor payment period, which is equal to 1 divided by over into 365. Right? This comes in days. Right? Or you can write the same thing with average creditors divided by cost of goods sold into 365. Something days. Right? This indicates on average, firstly, it indicates how many times per annum you sell your creditors. Right? Or on average, how many days you take to settle your creditors. It should not be very short. Every 2 days, every 7 days, I pay. No. It can be a reasonable period. But if it is unreasonably high on number of days, unreasonably small on creditor turnover, that means I pay only twice a year. I pay only 3 times a year. Then it is unusual, right? 4 months, right? Or I say it says the creditor payment period is 120 days, 150 days, 180 days, like that. Then you have to compare with the industry. Are they getting that much credit? If they are getting credit, there can be few scenarios. Yes, they are getting credit, but with a premium. You take 30 days credit, you are purchasing at 100 rupees. You take 160 day, 80 days credit, you are purchasing at 140 rupees. Right? What does that mean? Your cost of goods goes up, your pricing will go up because it is not the normal norm. Right? So your margin will come down. So this industry normal norm is 30 days or 45 days. But this customer is buying large credit period at a premium because they don't have enough working capital. That's why he's buying at a premium. So their margins would be smaller. All others in the market are buying at 100 rupees. This person is buying at 140. But he can't sell at a higher price. Why? Market is different. They are buying at 100 and selling at a particular rate. Since he does not have PODs and short-term loans or his own money to buy the raw material, he is buying long-term credit at a premium. This is bad. That is one angle of it. The other angle is customer is not paying. Right? He buys for 30 days credit, but he hardly pays. He drag and pay, drag and pay. Right? What is the issue? Suddenly, suppliers will decide, okay, forget about him, we are not going to supply. Then what will happen? Business will collapse. If, as a banker, if we have given him money, we have issues now because his business has collapsed. Right? His business has collapsed. Therefore, we need to be worried about that kind of a scenario. So at the beginning, you ask, what is your credit period you enjoy? You come here, do the calculation and see whether it is in line. If it is not, you have to see why. Why are you doing this? Raw material, you are taking longer credit. You are not paying. Or are you taking at a premium because you don't have funding lines? So that questions you have to ask. Right? These are the three key important ratios we need to know. Any questions of these three ratios? Can I have answer? Yes, no, good, bad?
Clear, sir.
Okay, answer. What about others? Few answers, please. තේරුණා නැද්ද clearද මොකද? I prefer to have some answers. Okay, thank you. Right. So these are three key ratios you need to know because this is important for our working capital. So, but you need to know it by heart. Right. This is the ratio we were talking about. Started with basically I covered three ratios. Right. Though it's in the handout we have only one or two, but I covered all the three ratios. Account receivable turnover, net trade sales, right? By net, it is commission or any returns, those things you have to take out, right? You can work this out from the figures we have given. Account receivable credit sales is 490, opening and closing balance 17 plus 20,000 divided by 2. Turnover period 1 upon account receivable turnover into 365. On average, how many days it takes to collect an account receivable, right? So debtor turnover period should be small. Then stock turnover period should be small. Creditor turnover period should be large as much as possible, right? But without a premium or bad repayment, right? Then it is good. So you drag your payments ethically without paying any premium, then it's good. But it has to be ethical. බඩු අරගෙන ඉවරලා ගෙවන්න නැතුව ඉල්ල පීරියඩ් එක වැඩි කරගන්න එක නෙමෙයි. You negotiate and get a reasonable period. So any business aim should be to keep the minimum stocks, faster debt collection, and longer repayment on trade purchase. Trade purchase without a premium. So you are not utilizing your money. So you are not wasting your money on interest. Right? So that way we should work. Inventory turnover, cost of goods sold, average inventory, measure the number of times inventory is sold. Then we go to equity or long-term solvency ratio. Right? That is to look at the financing part or the relationship between debt, long-term debt and equity. Net operating income, net sales is the turnover, net operating income is the profits, interest expenses, total stockholders equity, that is the equity. This number of shares, common shares, we need that net income, that is the profit, 53,000. So this shows the number of shares. This is the equity part. Dividend per share, market price, interest, expenses, total assets beginning and yes. Equity ratio, this stockholders equity. this one, right? This is the stockholders' equity. Total assets is the funding, which is total fixed assets plus net fixed assets plus current assets. This ratio indicates what is the portion of assets financed by shareholder. Right? This measures the portion of total assets provided by the shareholder. So that is, out of the assets, the investment in the business, 67% has been financed by the owners. Right? Only 33% has been financed by the debt, long-term financing. Why? Out of 100, 67% financed by equity. So it is a very good, like, low risk company. So normally we say debt equity for 60-40. That is the maximum a bank should finance. Why? 60% debt, 40% equity. So that is a very higher part. So based on your risk appetite, you can decide whether it's 50-50, 40-60, whatever. Debt equity. Oh, this is the equity rate. This is only the equity part. Right? So if we say 67, we forget about the 0.7, 67, that is equity out of the total assets, equity is 67%. So the debt 100 minus 67, 33 is debt. Right? So this one is written in different format. We have debt equity. So how do you calculate debt equity? It is debt portion divided by the total assets. Then it will come to 33 here. 33 colon 67, it is debt equity. Right? Like that we take. Or you can interpret it like this also. Per rupee of investment, 67 cents has come from equity, 33% has come from debt. Right? Higher the debt portion, riskier the business would be. Right? So it has to be a balanced ratio. Okay. Then net income to net sales. These are all profitability ratios. Right? I'm going back to Word document. Profitability ratios. All the profitability ratios are calculated using figures from P&L. Right? Mainly, not all, mainly. Right? First profitability ratio is contribution or gross profit margin. How do you calculate gross profit margin? It is GP, gross profit, divided by turnover into 100, which comes in as a percentage, right? Gross profit margin, right? Then the second ratio under this is profit before interest and depreciation divided by turnover into 100, which comes in as a percentage. Then we have, I'll write it down first, operating profit divided by turnover into 100. Again, it comes in. All these ratios comes as percentages. Then you can have net profit to turnover into 100, right? 100. It also comes as a percentage. So net profit can be profit before tax to turnover, turnover or profit after tax turnover, right? So these are some profitability ratios, right? So what is the profitability of a business? We calculate from this. So here I want to say something. This GP ratio, turnover, gross profit margin, right? We call gross profit margin. If you are doing a horizontal analysis on the gross profit margin, that means you are comparing gross profit margin of a business in 2019 and 2020, or 2020 and 2021. Like we take 3 years. 2019 gross profit margin, 2020 gross profit margin. We take this way. 2018, 19, 29, sorry, in 20, then we take 2020, 21. 3 years. GP margin, we write like this. So in this kind of a scenario, if the gross profit margin is 25%, this may be 24%, 27%. Right? Margins are almost similar. It changes in a very narrow band. It won't be like this. 25% here, 35% here, 18% here. It won't change like that. Why is that? Before the GP, gross profit, what do you have? You have raw material, you have labor, you have electricity, right? So whenever there's a change in these three items in the market, raw material prices increase, labor prices increase, or power prices increase, it affects everyone. So what happens when the prices are affected by everyone? What will happen? Every manufacturer or every seller will pass it to the consumer, you and me. See what will happen very soon? All the food prices will go up. Bread prices will go up. Why? Our gas prices increase. Right? Now the Prima and the flour guys will start shouting. They want to increase. Why? Dollar has gone up, so their raw material cost has gone up. When it happens, what will happen? Even our malubang will increase. Why? Raw material increase. So all the manufacturers, all the bakery guys will increase the pricing. Right? So when you are comparing a gross profit margin Normally, it would be in this line, right? It won't be on this line. Very rarely, it can be in this line as well. Why? Whenever there is a change in the product mix, this can happen. What is the product mix? I am a retail shop where I sell computers, refrigerators, TVs, like that. So 1 year I sell TVs mostly. So my profit margin was very high. Then the second year my demand for TVs has come down, but I'm selling computers where my profit margin is low. So due to the change in the product mix I sell, this gross profit margin can change. If not, normally it will not change in a larger tolerance, larger band. It will not change, but it will change in a very narrow. Why? Always, whenever there is a price increase in the direct cost, it will be passed to the customer. So that is a very critical point when you evaluate a business and when you look at financials, right? So you have to be thorough with that. So your profitability ratios are these ratios. It comes from P&L. Then we have, go to the presentation. Oh, I have a question. So net credit sales is credit sales minus return sales and commission. Yes, Hamza, it is net trade sales is return plus any commissions we pay. Right? So it is that. Anyone else? Anyone other than any other one who has a question? Okay. Right? So let us go to the presentation. Then this is net sales. I have given only one ratio here, but we have all other ratios where you need to know. Then we have the other one. This is return on equity, ROE, return on equity. This ratio indicates what is the amount of cash, right? Amount of cash available for equity. Return on equity, that is the shareholders' equity. That is profit, net profit, or after tax profit divided by average common stockholders equity, right? This is not number of shares, it is the equity, right? Per rupee the investor has invested, what is the return we have, right? Based on that only investors will invest. So we have a 25% return on equity, right? So you have to, this is a very important ratio from the investor's point of view. Investors' point of view, this is a very important ratio, profitability ratio, which indicates the availability of cash for them, right? Profit after tax divided by average common equity, shareholders' equity. Before going to the other ratio, which is the market ratio, if I can, yes, is the market ratio, I want to tell you something else, right? This is the profitability, then have debt servicing ratios for abilities. First one is interest cover ratio. Interest cover ratio, which is equal to profit before interest and depreciation minus tax, right? Divided by short-term interest plus long-term interest, right? Interest cover ratio. How many times your interest is covered by the profit before interest and depreciation. We calculate this ratio to find out the business's ability to service short-term facilities. Why? As I told you earlier, short-term facilities capital is serviced by liquidating current assets, but your interest portion is serviced by the profitability, right? Whenever you intend to finance a business on short-term basis, PODs or short-term revolving facilities, PIF post-import finance facilities, or PCS export finance facilities, you need to calculate this, right? That shows the ability to service the interest. Interest is serviced by the profitability, whereas capital serviced by the liquidation of current assets, right? Then we have debt service cover ratio. We note it as DSCR. This indicates the ability of the business to service the long-term debt, right? Any debt which is more than 12 months period. PBID minus tax divided by right, divided by long-term capital plus interest plus lease rentals, right? So earlier you can take lease interest portion of the lease rental here. When you are taking the entire lease rental, you can take that out, right? This DSCR ratio indicates the company's ability to service the long-term debt, right? Always, yes, we do all these calculations, but still customers does not pay, right? We need to, for a smaller company or SME, if you can take out some drawings, it is technically you don't need. So if you are to calculate just the ratio, you don't need this. But in your day-to-day operations, if you can take out some money for the living of the owners, then it is better, right? But technically, you don't need this. It's finishes here, right? So always DSCR should be more than in the range of, you can say range, if you have 1.5 times, that's a reasonable thing. So even a fluctuation will accommodate your long-term repayment. But if it is 5 times, similar to current ratio, if it is 5 times, that is not good. Why? That means the customer needs to pay only 50,000 rupees in for their long-term debt, but he has the capability to pay 250,000. So what happens? The balance money he may divert to different things. By diverting that, he will have problems in his business. Therefore, always we should aim to collect our money as fast as you can, right? So you should not be happy, say that, okay, there is a huge DSCR. So you are opening up the doors for the customers to divert their money to other things, right? When they go and divert to a wrong place, entire business will get stuck. So you will have issues. So you have to give out money and take in the money as fast as you can, right? That is the debt servicing ability. Then we go to this. We discuss this, then we discuss that. Then we come to the market ratios, right? The first market ratio is earning per share. What is the income we get per share? Earnings available for common stockholders, right? That is the distributable profit divided by weighted average number of common. ROE to weighted average equity. This is number of share. Per share, what is the availability, right? Profit divided by number of shares. That means earning per share, it is 2 rupees and 42 cents in this case. Per share, what is the equity? Per share, what is the profit? Distributable profit. ROE is per rupee invested, what is the profit? Here, per share, what is the profit? I have 2 shares, that means I will get 2.42 into 2. Right? Then we have price earning share ratio, and we have earning per share. Then we have price earning ratio, a valuation ratio of the company's current share price compared to the per share earning. Per share, I am earning this much, whereas market value of the share is this much. Share price, current share price. So it is current share price divided by earning per share. So I have 2.26, 8.26 here. That means market value is much higher than the earning per share, right? Market value is higher than earning per share, right? So when you are comparing listed companies, you calculate these ratios only for listed companies, right? PE ratio and earning per share. Then we go to the summary. Right? Ratios help to evaluate performance. You saw the ability to evaluate performance, profitability, management thinking, efficiencies, all those things we evaluated through ratios. Structural analysis, that is the equity and debt, how the business has been financed, or short term, long term, all those things we can evaluate through ratios. So the connection between activities and performance, that is, activities are collections, payments, all those things. Benchmark with past of for the company. We evaluate the past and the present to predict the future. Then we compare industry, right? We know on average, food industry will have a net profit of 40%. If this company has only 10%, we need to know why it is. When we are talking about ratios, we avoid the size difference. Right? Can you remember the common size balance sheet and P&L? Yes, we avoid the size difference. Otherwise, what would happen? A billion company and a million company, you can't compare. Limitations, these are the limitations we have. Industry category, whether it is large or small, we can't find. Industry averages are only averages, only guidelines. Company to company accounting practices may be different. How you recognize turnover may be different. How you recognize your depreciation may be different. So it is difficult. Sometimes ratio interpretation can be difficult without proper information. Seasonality effect ratio. Yes. We compare March to March, suddenly a September figure comes in. So the ratios are totally different in September. Why? The season is in December. So it can be agriculture seasons, it can be commercial seasons, anything. So like I give an example. Shoe manufacturer, school shoe manufacturer, or any shoe manufacturer, their season starts somewhere in August, September. But if it is a shoe seller, their sales starts in December, January. Right? So there is a difference in season. So if you take shoe sellers account for September, you miss the December figures. So your ratios would be different. Requirements would be different. Shoe manufacturers, if you take June figures, again your ratios would be different. So seasonally affect the ratio. Then this one, common stock valuation based on expected cash flow. So ROE is a critical evaluation. The cash available for rupee of investment. Ratio influences expectation. Why? Ratio shows where we are today. Based on that only we predict the future. Showing the development that will alter further future performance. I have two questions for you. Right? Current ratio is a measure of liquidity that is computed by dividing total asset by total liabilities. Can I have an answer? I would like to see an answer. Yes, no, false. Not you, everyone. Go ahead, go ahead. There are other people. I got the answer from 1, 2, 3, 4. Only 4. I have 17 in the class now. Okay, it is false. Then the second one, ratio. The other one is quick ratio is a measure of liquidity that is computed by dividing total assets by total liabilities. Current ratio. Oh, where am I? Quick assets are defined as cash, marketable securities, and net receivables. Is that true or not? Okay, right. Okay, thank you. And I think we are done on the ratios. Yeah, we're done with the ratios, right? So if you have any questions, I can answer. We have around 5 minutes to go. If you want, I can. I'm ready to answer you any questions, any clarifications. Otherwise, we'll stop for today and we'll start with working capital next week. You can ask me any questions if you have.
Sir, can you explain that second
Right?
question,
Otherwise,
quick
thank you.
assets?
I will be here. You can ask me questions, right? Quick assets. This one, quick assets are defined as cash, marketable securities, and receivables. Right? Chagita, I told you quick assets. If we have the details, we should take only the debtors security. Marketable securities are blue chip company shares, then cash, whatever can be easily disposed, right? So in this, can you see this? Right? These are the quick assets. Right? Quick assets are cash, marketable securities, account receivable, and current notes receivable. Right? That's the money given out which we can collect fast. Right? These are the quick assets. Right? Is it clear? Right. Any other question for anyone? No, we don't. Prepayments, if given, you can take. Only we deduct only the inventory. Okay then, thank you very much.